Thank you for joining us for a info chat interview. My name is Denise Mejia. I'm your host today, and I'm the founder of Crypto Lens, where we encourage innovation, compliance, and education. Today, with us, we have John Potter, the founder of Founders on Chain Capital newsletter, a technical content writer who helps blockchain and startups secure funding. Very hot topic these days. John, thank you for joining us. How are you?
Oh, just fine. Thank you.
We're excited to have you here. And for those that may not be familiar with what you do, maybe you could tell us a little bit about yourself and what got you interested in this topic and led to creating your newsletter.
The journey started as a technical college librarian. So I was interested in all things technical for a long time. And I was looking at a crypto, I think it was Coin Market Cap. So I was looking at all these new coins, and I was like, this is really interesting. What's this all about? And that was in 2017. And I was looking at the prices, and I thought, wow, this Extra Bytes, which was a small outfit, looks kind of interesting because it's unlike all the others. And so I kind of started to blog about them. And this small outfit actually contacted me after a few months of writing about crypto token, their crypto token, and asked me to come on as the copy manager. So that was a lot of fun and very enjoyable. Eventually I moved on to other tokens. For instance, I did some writing on something called quantum resistant ledger.
Mhm.
That was exciting because they were one of may have been the first token, I believe, that was billed itself as quantum resistant. And so just writing about that got me into quantum computing and quantum computing resistance. And so eventually I ended up writing about quantum computing for a European a European magazine. I also work for a crypto marketing firm, and so eventually I got hired to do other technologies. I got into AI a little bit,
Okay.
mostly data automation, data management, that type of thing.
So raising capital for startups. How did you start writing about that topic?
Well, I always admired entrepreneurs when I was younger. I would,
Mhm.
read magazines that would talk about new startups, and I just found it really inspirational. I was inspired by what some of these founders did, and I also saw it in action with Extra Bytes because it was a small enough outfit where I actually knew the founder well enough to be on a person-to-person basis with them. So you know, the whole idea of you can do this, you just need the capital, and maybe there's a new way to do this
Okay.
is kind of exciting. A
Yeah.
new way to raise funds, that is.
What does the current capital raising landscape looks like for blockchain and 3.0 startups?
Well, the landscape's a lot more mature for blockchain. You're getting a lot more institutional investors, and so even more than 2 years ago. So investors are much less prone to hype. They're more focused. They're much more selective. Um, there's a big shift now to um, the type of projects that get attention are more utility focused, in my view. And there's also a key to there's also investors who are looking for specific things in their tokens. For instance, they're looking for tokens that are focused on faster settlement, perhaps automated revenue flows. They're looking at tokens that can provide verifiable data for compliance logs or asset tracking. The other thing is uh, um, they're looking at also new markets that are suddenly springing out out of necessity, like decentralized physical infrastructure networks. And the capital sources are pretty uh, set in stone. You have the traditional venture capital firms, and these are the blockchain companies that really focus on, they look at blockchain companies the way they would look at a business. So they're looking at demand and revenue and what's the go-to market plan. They're not that interested in the white paper yet. They're really just, it's all about business fundamentals. The second source of capital out there are these crypto native funds. And they're, while they may be somewhat business oriented, they're more focused on tokenomics and looking for a strong token mechanism. But they're a little bit more disciplined than they used to be. They're more uh, focused on value, just like the VCs are. And they're not really focused on token emissions as much as they used to be. And then the final third source of capital are the community contributors. And these are the people that are really passionate about your project, and they're going to play an invaluable role for any project. And some of the things that have made their role even more important when you're funding right now is that the SEC exempted some of these micro rounds from being taxable events. And so this clarifies a lot of what can be raised in terms of funding from these contributors. The Reg CF, this is it's Reg CF is for crowdfunding.
Okay.
So it says basically that this SEC exemption basically says individuals can only contribute a certain amount, and that projects can only raise a certain amount. But if they stay within those guidelines, it's not considered a token generation. So when you have that type of clarity, you have more people jumping in, and there's less concern about being in a situation where you might be liable for taxes, that type of thing.
So, what do you think are the trends and maybe opportunities for founders today, and what they should be aware of when it comes to raising capital for their startups?
The trends,
Yes.
uh, the trends, I would say, well, there's four areas right now that are really seeing a lot of revenue flow. The four are telecom usage, and then there's energy credits, and that's, when you think of energy right now, that's quite dynamic because of AI. There's creator royalties, that there's revenues flowing into that, and there's freight payments. But all of these are fairly big industries where they're dealing with slow settlement. So they're all prone to disruption. So, and in general, any time cash flow hits a smart contract, you can build a business around that. And some of these do deal with smart contracts, so there's a lot faster settlement. So that's one big trend. The second big trend, I should say, is that uh, agentic AI is emerging, and this is going to be a very big change for everyone. I actually have a newsletter called Founders Agentic AI Playbook on Substack. That goes right along with my blockchain Substack. So this is right up my alley. One of the things that's really interesting AI is about agentic AI, as opposed to Gen AI, is that you have these bots or AI agents that can do all types of really interesting things on your behalf. But when it comes to money, that's a different situation altogether. So blockchain is a natural merge pairing with AI agents. And I'll tell you why. The reason is because you have these AI agents that need payment rails. They need permissioning, kind of like the way a software has access, an access control layer. They have what else? Identity rails, and they need audit trails. So, you know, all that stuff is to build some credibility among users of these, not credibility, but people want to feel safe with these AI agents. And so blockchain is a natural for that to have. So in a sense, you have AI agents being the trigger logic, and then you have blockchain being the money mover. And so they work really well together. Still kind of early, but if you want to look for a trend that's going to make a big difference in the future, this is it. So there's two more trends I should speak of. There's tokenized tokenized operating rights, which is what a lot of startups now are uh, looking into, uh, because what happened like within the last 2 years is you had a lot of uh, things that startups needed, like storage and bandwidth
Mhm.
and compute credits, and they couldn't afford them because they were on fixed contracts. So they didn't throw up their hands and just leave. What they did is they created an open market where you could trade these digital resources. And so with that ability to trade on a marketplace, it lowered the costs, and it also created a situation where the contributors were getting revenue streams from it. So kind of a win-win for everybody, except maybe the fixed contracts, but uh, the vendors with fixed contracts. But even they are probably getting more usage and more revenue because of the ability to trade these digital resources. So that's happened in the last 2 years, and it's just going to get larger and larger. In fact, I just wrote an article about it because uh, it's just kind of emerging and getting larger. And then the fourth one is probably right up your alley. There's more, uh, regulatory clarity out there. So uh, right now we have the SEC's Reg CF, the crowdfunding exemption. We have another um, reg called Reg D for larger fundraising rounds, and that it's a lot clearer now about what the SEC expects in terms of funding. There's a little bit less murkiness, and with that, there's also some third-party tools emerging. So, like for instance, if you're going to be selling equity to get funding, for instance,
Mm.
you used to be able to use something like Pulley. Pulley deals with tokens, but it's not their main focus. But now there's another tool called Magna, which is a crypto outfit that is trying to get a real good name for itself, just with vesting, that type of thing. And then there's another third-party tool called Hedging, which does token unlocks, and they're also kind of right behind Magna in terms of becoming well known. And then there's this other really great tool that I find really fascinating. It's these tools are becoming more popular. They're getting a lot more publicity because people need them. So, for instance, this Superfluid tool is it does streaming distribution of tokens. So, if you just need like someone to start distributing tokens on your behalf,
Mm.
instead of just doing it yourself, this can do like small amounts of tokens on a regular continual basis. And it can be set for like certain time amounts. So all these things are coming together that are making things a lot easier for people in the blockchain. So, and especially compliance. I mean, that's really becoming less of a burden and more of a feature. So now you have all these companies coming in that were kind of hesitant to do so, and I think they're feeling a little bit more relaxed about going forward.
Makes sense.
Yeah.
The key difference between a traditional startup versus a blockchain startup in for you as a project owner to go out and find investors for your project?
Blockchain is more than just building software, because when you're dealing with blockchain companies, you're not just building the technology, you also have to build an economic system around it at the same time.
Mhm.
And so sometimes, as a founder, you're going to be ending up pitching how certain value flows. You don't have to do that with traditional startups. You just have the dollar. It's there. It's not going anywhere. But um, tr- traditional startups don't have to worry about that. But with tokens, they can fluctuate and uh, be distributed for multiple reasons. So that's one issue. Um, so when you have investors coming forward to kind of evaluate tokens, they're going to look at uh, token mechanisms, like how they're designed. They're going to look at the underlying economic system, and then they're also going to look at the tech. So that's a lot to take in at all once. So let's say you got one of those right and two of those wrong. That's still going to affect the way investors are going to look at your project. So no matter, even if you have a really great business model, if your tokenomics are off, people are going to second guess that. So that's an issue.
Yes, and
Um,
going forward, hopefully compliance will be included in that mix.
is I got a few more. Most of the issues with blockchain startups is they got to raise funds before they even go live. So they have investors looking at incentives. They're looking at early demand signals. They're looking at the entire economic system. They just want to make sure everything is sustainable. And that's not true of course, of software. I mean, you could raise money before you release software, but this is very common among blockchain startups, is to do all this fundraising before you even, launch a token. Um, and so it's less about short-term revenue and more about proving that your token or network can actually scale so it's viable. And the other thing with fundraising with blockchain is you're dealing with a whole different investor mix. So let's say you're creating software. Well, you might go to a VC if you're lucky. VCs are very picky right now, and they're almost all exclusively, it seems like, at least to me, focused on AI. And I actually think that's a real danger zone. But with with blockchain, you have venture capital, which is one way to go, but you're also looking at crypto native funds, and you're also looking at your own community contributors. So, like I said, the three sources there. And so every one of those capital sources wants something different. So when you talk to VCs, they're going to talk about business value. When you talk about to capital native funds, they're going to want to talk about your token mechanics. And uh, contributors are also kind of important here, because they can create a real headache for you if they're not on your side. Um, so like I go on Twitter, or X, I suppose you could say, a lot, and what I see is uh, a lot of disgruntled investors with small projects calling these projects scams. And when you come right down to it, what the investors really want is more transparency. They don't know what's really going on
Right.
behind the scenes. The contributors to this project, they also want everyone's incentives aligned so that everyone's following the same direction, and that everyone's included so that the project can move forward. So there's very definite particular demands among the community members that are helping your project. But they're really invaluable, because if you don't have community members that believe in you, you won't attract other investors, and you also won't attract you won't get their help, because they'll be second guessing you, and they'll always be, you know, uh, it'll just be hard to get them. The most passionate contributors to your project are the ones that are going to go above and beyond, just like in any other project. Um, but again, if you're trying to deal with all of these investors, three different investor sources, you got to kind of speak their language, And you have to know how to pitch to them, but still keep your core story straight. So that's very important. That takes a little bit of talent. You have to know what they're looking for, what they're asking for, be able to sell to them, and know how to speak to each one based on what is important to them. So that's where the preparation matters. So you're not just, all this revolves around is trust and building trust and building an economic system that people believe in. Now, I use that phrase economic system. Basically, what I mean is people believe that the tokens aren't going to bankrupt them, so to
Right.
speak. Yeah, they don't want their investment to go to zero. So, in answer to your question about funding in general, everything is a little bit more calibrated now, and there's more investors being very selective. But if you have the demand and you have the economic system down and you can show some real value, capital will find you. But the key is clarity, and the key is being persuasive and uh, following a predictable path along that way to get that funding.
Makes perfect sense. A lot of startups, leaders, and companies, they could benefit from a playbook that would kind of define a process for them. Putting my process hat on. Okay, this is in addition to solving this challenge, and these are all the key elements you need to have checked before you actually go out and look for funding for your project. Can we shift to how founders can prepare for funding? So
Sure.
maybe the breakdown of the typical process involving securing capital for blockchain startups.
Okay. Well, before you even get to the funding part, you got to get your story straight. And I think what is happening now is you have founders who believe, maybe a few founders who are not really well informed, believe that they can just have one big funding round and that'll be it. But that's not really the way it works anymore. Um, if it really ever did, what you're doing now is to get to where you want to go, you have to have a series of small validations. And so you're going to start off very small and then kind of grow larger and larger and validate everything that you do. So before we get to that, though, you kind of have to have a strong narrative. In other words, you have to, when you meet with investors, they're going to say, okay, well, what's the pain point you're fixing? Um, who is the solution? Who does this solution serve? And why is the blockchain involved? And if you don't have that nailed down, investors will say, well, maybe this is just software attached to a token, say. So you kind of have to be careful that you get that first and foremost, because you're going to use it over and over and over again. The next thing is you want to get your token mechanics down. It's kind of like if you were an investor, you kind of want to make sure the car's engine is moving forward before you actually build the car. So you want to make sure everything about the token mechanisms check, and that there's not something hidden that you don't know about that's going to create future problems down the line. So, for instance, let's say you're building a lending protocol. The thing that you want to show investors is that maybe a small part of that, like the prototype, can handle collateral, for instance. Or let's say you're creating a revenue streaming demo. You want, or a tokenized revenue demo. You want to show that they can handle streaming revenue, or even if it's something to deal with the supply chain, you want to show an investor that you can actually verify the data on chain uh, that relates to a supply chain event. So all these small parts mean something to investors, because it says that this is fairly feasible. So once you get the narrative down, the mechanisms, the token mechanisms down and explainable, then you start building your materials. And the first material that is really important is, of course, your pitch deck. But you don't want to just have the pitch deck. You want to have like a one pager to give to people, maybe a diagram or two when it comes to um, token mechanics. Um, you also maybe want to have your token model there so people can understand it. And you just want to have enough to show direction and that you're serious. But this is not the time to show like a white paper. That can come later. Um, and then the fourth big thing, and this is really key, is you'll gain a lot of credibility for this if you can get like a design partner to partner with you. So that really validates the investor's concern because they're saying, well, here's another outfit that really takes you seriously and finds you credible, or any one real user who believes your product can help them and meets with investors and says this is why. I mean, that's just gold to investors because it validates their concerns and they feel a lot more confident. Um, so it will unlock a lot of funds for you. And I really can't stress enough how important this part is because I think investors, they tend to look at other people to kind of say, well, is this right? Am I right? Or am I just kind of talking myself into investing something? And so when other people come along and are enthusiastic, especially if they're like more than, let's say, a contributor, let's say a real company, design partner is the fourth issue. And basically, it's just to validate what investors are concerned about. They just want to make sure that you're a credible project. Once you get all that stuff, just execute uh, certain small issues with the project, like deploying a contract, getting your pilot running, um, collecting revenue, just to give confidence to the investors.
When you think of the key requirements and documentations the project leaders and owners should have ready when they go to look for funding for their projects?
Right. So one of the first things you should have is something called a SAFE, which is basically an agreement, a standard agreement with investors uh, to wire money. So it's just something you should bring with you to an investor meeting because you never know if an investor is going to go immediately to wanting to wire some money. The next thing is you want to have a token warrant, which is all that is saying giving an investor future token rights. So, for instance, it's an agreement basically saying when the token launches, you'll have X amount of tokens, or later on down the line at a certain time, you'll have access to a certain amount of tokens. And then for your community, the people that are helping you out with the project, you want to just have a clear, sheet as to risk. The risk involves what the project details. You just want to be very clear with your community contributors what they're getting into, so that it doesn't create issues down the line. But there are also a few other things that you probably should also have. Um, for instance, you might, if you're going to be giving some equity away to get some investment, you also want to have, show them that you have a clear cap table. And you can get something like from Pulley to create a cap table so that um, the investor can see how, that they're going to have a certain amount of equity at a certain amount of time once the project launches. The other things is you want to safeguard yourself as an investor by looking at the founders agreement to see what the founders have agreed in terms of ownership and how to resolve disputes and anything like that. And as far as disputes are involved, anyone who has run a public organization knows that you want to have bylaws. Bylaws are really important because they kind of set in motion or set in stone kind of like how to resolve disputes. So nothing seems very arbitrary or kind of by the seat of your pants. And in the same breath, you also want to have a operating agreement so that investors can see that the company was formed, or the project, whatever, was formed in accordance with the way it should be, and how it was formed. So um, even a simple thing like an IP assignment is important, because let's say a founder comes up with this great idea and he gets copyright, intellectual property rights to this idea. Um, investors are going to be wanting to know, does that belong to the company or to the founder? Because if it belongs to the founder and the founder walks away, that leaves all the investors to the company high and dry. So you want to look at that part too. So all those things are important. Anything that can give investors confidence that there's not going to be a problem in the future with founders walking away, with disagreements, with anything that seems arbitrary. That's really important. So when you have all this paperwork together, it really signals professionalism, and without it, you look kind of unprepared. So those are six things that you should have: the probably a cap table schedule, a founders agreement and IP assignment, well, more than six, an operating agreement, a bylaws, a safe in case investors want to wire money to you, a token warrant, and then any community offering materials so that community contributors are feel safe to invest.
That's a great point. How about technical documentations like white papers, maybe summarizing some of those technical documentations and maybe translating them into more human readable forms would be a good idea.
One of the things that is really terrible with white papers that are done is that they'll talk about tokenomics or the technology first. And really, if you're going to do a really good white paper, you talk about the problem first, and you don't talk about, say, supply curves or um, you know, really technical stuff, because people's eyes just glaze over. Um, but when you meet with investors, just bring like a one pager or diagrams, just something to make it easier. If you hand a long white paper, even if it's put together well, people don't want to read a long amount of text. They just want to get to the gist of what the issue is. So that's why you want to have like a 2 or 3 sentence problem statement as to what you're actually doing, what you're actually creating, and don't make it complicated, because investors they lose confidence when they feel like it's too hard for them to understand. They have to think in terms of what the investor wants, what they're seeking, and not just have blinders on when it comes to that.
Totally agree. Simple is better when it comes to pitching an idea or really a project. And then, of
Right.
course, you can have the link to more detailed technical documentation is needed, because then they can get the experts to review that and opine. What are some of the biggest risks founders face when raising capital in the blockchain space?
Well, the biggest risk by far is you're raising funds in a way that kind of locks you into the wrong economic model. And by that, I mean um, you launch a token, before there's a recurring value loop. So, in other words, you're launching a token and there's no revenue coming in, and there's no there's nothing there except for the token price. And so all of a sudden the token price becomes a scoreboard, and then everyone on the team is optimizing for hype, and they're not really optimizing for usage. What you do when you create a project like this, you want to optimize for usage. And if you don't, um, your focus is on the wrong thing. Another thing is that you want to make sure that you stay in your own lane when it comes to regulations. You don't have to be a lawyer, but you do need to know that Are you offering an equity? Are you offering a utility token, a revenue share, or something hybrid? So the SEC doesn't really care how great your project is or how innovative it is. Look at Ripple. Ripple had this great project for banks, but it was dragged through the courts by the SEC for a very long time because they couldn't decide if it was a security or not.
Mm.
And the SEC said it was, and they said it wasn't. And it kind of created a drag for a long time on that token called Ripple, which is very big now. So they don't really care about that, about how great it is. What they care about is, are you selling a security without being registered for it? Because there's very specific security rules that you have to pay attention to. And if you don't pay attention to them, you can get in a lot of trouble. So you should be able to explain what your token does in one clear sentence, what your token model does. And if you can't explain that, is it a security? Is it a utility? Is it revenue share? Is it, debt? Then you're really taking unnecessary risk. So definitely pay attention to regulations and don't give them short shrift. That's really a really big mistake that, and if you get investors who say, oh, we'll just figure out the compliance later, that's a big red flag, and that can really create problems down on the line.
Are there specific red flags that a innovator should be thinking
Investor?
about when um, reaching out to investors and having those conversations?
Yeah, I think when you're dealing with investors, a lot of times you'll get investors who want a huge chunk of your token supply. And I use the word token supply, but let's just say a huge part of your treasury, for lack of a better word, just to make it simple. But they're they're going to write a small check for you, relatively small to your standards, and they want, let's say, 20% of your tokens up front. Well, that's kind of extractive, and they're really thinking short term. So you have to think what you're trading here and not just be yes to whatever the investors' demands are. Um, Another issue is when it comes to tokens is some investors will want you to speed up the token generation event. And by that, I mean like selling the token just to get more liquidity, uh, uh, for themselves. So, um, good investors will help you design healthy token mechanics. A bad investor will try to push you to list your token on an exchange before the product's even ready. So you have to kind of be aware of what some investors' ulterior motives are. Some are thinking long term and want the best for the project. Some are thinking short term, and this goes to the most important part when you're dealing with investors is if you're going to trade equity for money, make sure that if you're going to trade equity, you don't want to do it just for money. You want to get investors who can distribute your token. So if let's say you have investors who like are aware of a network or a partner or maybe a user group that can help distribute your token and promote your token, that's what you want to exchange your equity for. If they're just going to give you money, it's not really worth it because you don't want to give up part of your company just for a check. You can get that later on in some other way. So always be aware of what you're trading ownership of your company for. Don't just do it for money. You just decide to get your funding a little bit slower if that's the case. So that's what I would say.
I was at blockchain innovator and I'm looking to obtain fund. What would be the mediums or resources where I could go to? So how do I go about even getting started?
Well, I think the first thing you have to do is, let's say you have a killer idea but no money. The first thing you want to do is prove to investors that what you have is feasible. And the thing to do that is you want to do the hardest part of your project first. Don't if you're got this great idea, don't start on the user interface, don't start on tokenomics, start on something that if an investor sees it goes, wow, I didn't think you would pull that off. That's really great. Now I believe in you. So for instance, if it's like a smart contract that sells something automatically that you didn't think could be done, that's great. If it's let's say a prototype that uses testnet funds, a test net being like, a prototype that actually does something similar to what the project does. It's like a stage to the final project. So anything like where you can, anything that someone might think is risky or not possible, and you can prove that to an investor, they're just going to love that. And so that's something that you should consider. And a few other things: don't rebuild the blockchain stack yourself. In other words, don't do a lot of coding. Most of what you need out there, like don't create your own cap table spreadsheet when you can use Pulley if it's going to take you too much time. Um, if you need other blockchain parts, most of what is there's stuff out there on the market that you can use already. Just stitch these things together. Like, um, for instance, if you are into streaming payments, you can use something called Superfluid and use that. You don't have to reinvent the wheel. Um, so be aware of all these things that will make your job easier. Don't just start writing code um, without doing your research. Um, and then, really, what's really important is you want to tell investors, show them all about that your project has some demand. So, how would you go about doing that? Well, you could, create maybe a wait list. That would be one thing. Maybe run a pricing test. Maybe create a kind of a bad landing page, but something that maybe might attract some people. See if anyone signs up as being interested. If no one signs up, that's a hint that maybe you should kill that idea because no one's interested. If some people are interested, then you already have evidence that there's some demand for it, and then investors will kind of flock to it.
Makes sense. That's a great advice for startups. So thinking ahead into the future, how do you see blockchain startup funding evolving in the next couple of years, especially with all the changes? And we know that this space moves really fast.
Well, I think first and foremost, if you really want to be cutting edge and get ahead of everyone, I really, really believe that agentic AI, once it merges with blockchain, is going to do your bidding. you know, it might even totally redo the internet because you have AI agents negotiating with each other, or AI agents getting whatever you want instead of you having to go to the website. I mean, that's kind of way down the line, but people are thinking that in those terms already, where there's people have their own AI agents and they're doing whatever needs to be done instead of the person doing it. There's also going to be some more. There's other trends out there, like there's going to be more tokenized debt. There's going to be more use of cap tables. There's going to be a lot more micro funding rounds, and there's going to be more people probably going for equity, but they're going to be much smaller portions of equity to get in on companies. So all these things that are just kind of emerging on a slow basis. But they all make sense when you look at it from the point of view of, a industry maturing, especially like cap tables. If you start seeing cap tables in the blockchain space, that means, you know, this is becoming much more mainstream, and people are used to asking for equity in the crypto project.
Excellent. John, where can people find your newsletter and where can they follow you?
Well, my newsletter is on Substack. It's foundersonchain.substack.com. You can actually also reach me at johnpottergr@gmail.com. And if you're at all interested in agentic AI and you get on Substack and find my profile, you'll also find that newsletter there uh, with my profile. So, I've been in blockchain for a long time, 8 years, and I like the energy, and but it's really coming into its own and becoming a much more mature industry, and that you can see that with the focus on compliance and the people feeling that it's safe to get into, because without a focus on compliance, people are kind of, they're a little bit iffy about it because they don't want to be liable for taxes or falling, going against the law.
Thank you so much for your really helpful insights. I think that a lot of startups could benefit from reading your newsletter and also this conversation. We look forward to inviting you back again when you have new topics you like to discuss. And thank you so much for your time.
Thank you. I enjoy myself. Thanks.